a lot of people think, well, I'm going to wait for prices to go down. I'm going to wait for this. I'm going to wait for that. Well, if prices are going down, that means rates are going up.
The variable rate's got to be a little bit lower in theory than a fixed rate, is because you're inherently taking on that risk. When you're taking a variable rate, you're taking the risk of interest rates going up, which they have. So to compensate you for that risk, we're going to give you a bit of a lower interest rate.
Wow, Scotty, another solid intro there, and I don't think we're going to be changing it. I mean,
it doesn't seem that way.
Spring has come and gone, so has summer, and now we're here in fall. So we're going to ride the intro, and we haven't changed the name either. So looks like, I mean, we had a little pushback when we wanted to change the WESPN name. I think people actually like it.
Yeah, maybe next spring though.
Maybe next spring.
Who knows?
We'll see. We'll God willing, we'll be here, and we can change it up. How are things?
Not too bad. As you well know, we just got back from Miami, which I would like to say is not real life. So now trying to reintegrate back into society.
Yeah, it's been difficult. It's been difficult, but our good friend, partner, and colleague, Chris Toldo's getting married. Congrats to Chris. Shout out. And we sent them off in style. Some beautiful churches in Miami.
Libraries.
Libraries were as quiet as ever, and it's just the right spot for us.
Yeah, pretty incredible. Great folks.
Yeah, and all the while, so it was nice to get out there. Weather was great. Kind of exit from what's going on down here in this market, and things continue to change, Scott. Things continue to change out there, and it's really nurturing everybody and educating them on what's going on and what's changing. And I think this episode that we have today is going to provide some clarity that everybody's looking for. Some straight goods, what's going on with interest rates and mortgages, variable, fixed, all that stuff. And, we got Matt Larocque from Cibc here.
Yeah, really looking forward to this. We have a general understanding of that stuff, but it's great to hear from an expert that's doing it every day, day in and day out. What I'm seeing out there is obviously the interest rates are continuing to impact the market, and I don't see that changing until we get clarity and stabilization in interest rates, which right now we don't know what they're going to do. We don't know when they're going to stop. We don't know how high the rates are going to get. How do you operate in that environment? So a lot of people are just sitting on the sidelines and waiting for that clarity. So it'll be great to hear Matt's thoughts on when we might get that, because until we do, it's going to be pretty choppy.
Yeah, no stability out there. I think the rates are going up again. I think they're going to go up this, that, the other. Like nobody knows. So it's kind of I think everybody's in a sit, wait, and hold pattern. Sellers, we're seeing the amount of listings start to come down because I think sellers are realizing that, you know what, I'm not going to get that January, February, March, April number. This number looks a lot different, and my delta has changed. Now, if you're playing in the same sandbox, you should be okay. But we're going to see the listings start to come down, and we already have. But that's going to result in serious sellers and serious buyers all trading real estate and integrating with each other, and that's an enjoyable market to work in as well.
Yeah, people have to move. People want to move regardless of the environment. There's going to be action out there. But the hesitancy is, number one, you're not getting the same prices you were back January, February, March. So people are just less motivated to sell. And number two, you're going to be getting a different rate. So if you got a great rate for another couple of years locked in, it might be hard to trade out of that and into a higher rate as well. So
that's a great point.
Yeah, so some broad view of what's going on there. But hey, we're still seeing transactions, and we're still getting the job done when people need to or want to make a move in this market.
I mean, I know here at AWF we're still selling a lot of real estate, having some great success there. The process, the transaction, the appointments, they all look different though. The marketing throughout the listing, that looks different as well. The communication with the sellers, that looks different as well. Whereas before, we're just in constant communication with sellers, showing 4 to 5, showing 5 to 6, showing, see you Thursday at my office for offers, and then you get carried out on their shoulders, and off to the real estate Hall of Fame we go. Now it's a little bit different, right? It takes a little bit more time. I've personally worked in this market before, and when things settle down, it is a very enjoyable market to work in. But the whole process, the whole marketing plan, everything is totally different.
Yeah, it changes, but we adapt, we adjust our communication and marketing strategy, pricing strategy. Sometimes you got to play with it a little bit more. Hey, we tried this price, it didn't work. Let's relist. Let's come in at this. This one down the street just sold for that. That gives us some guidance on, because a lot of it is we don't really know always what the market value is because it's changing so quickly.
Yep.
And we don't have great comparable sales when the market is statistically dropping at $7,000 to $10,000 a week. We're trying to keep pace with that. So we really got to be on the ball, watching the market every day, updating our sellers, updating our buyers, and very, very active. We're very active in this market with that communication. So game has definitely changed.
Yep. Bottom line is average sale price at our peak, 732. Average sale price at the end of August. Obviously, this is being recorded end of September, but we'll have those numbers soon. But end of August came in at 520 average sale price. That's a big difference, and that's going to continue to come down. I feel like until the interest rates either stabilize or come back down. I think the sellers are still wanting this, and the buyers can only afford this. It's not that they don't want to pay that; they simply can't afford it. And until the sellers come down to meet what the buyers can afford, is when we'll reach some balance.
Yeah, and a great way to put it is that most buyers are buying a monthly payment.
Yeah.
They're not buying necessarily a mortgage. They don't really care if the house is $750 or $550. What they care about is how much is it going to cost me every month? What's my income? Can I digest this mortgage without impacting my lifestyle? Is it a digestible monthly payment? And that game has changed drastically. You're talking about a doubling in monthly payments with these interest rates up. 400%.
Something you posted the other day was, which I thought was great. You could either have it cheap money or cheap housing. You can't have both at the same time.
Yeah.
Wow.
It would be an oxymoron to have both. Yeah, that's just not how the game works.
Yeah.
So a lot of people think, well, I'm going to wait for prices to go down. I'm going to wait for this. I'm going to wait for that. Well, if prices are going down, that means rates are going up.
Yeah.
Which means that you are getting a trade-off there. And I always advise people, don't try to time interest rates. Don't try to time the market. It's impossible. What you should be doing really is buying a monthly payment that you can digest and can afford, and don't really worry about where those rates might go. Nobody in the history of the world, you can do your own research, has been able to time interest rates. And interest rates impact the market. You can't time either of those things, and it's always lagging, right? Matt's going to touch on this. I'm not going to get too much into that. I want to hear from Matt on this stuff. So,
without further ado, I'm looking forward to this episode. Let's get Matt in here, and
awesome.
Again, it's going to be a straight goods financing and interest rate and mortgage episode, and really going to break it down and give you the good stuff.
Yeah, really looking forward to this.
All right, Matt. All right, so here he is, Matt Larocque from Cibc. I guess tell us a little bit about yourself, a little bit of background, and all that stuff. First of all, congrats on the new baby.
Thank you very much. Yeah, just had a newborn. He's a couple months old, Sonny. He's doing great. So thanks for the congrats. Yeah, I've been with Cibc for a little over 10 years. Spent about half of my career in commercial lending, and the latter half in more residential lending. So it's been a good mix. And obviously, the last 4 or 5 years have been a pretty wild ride.
Yeah, but mostly on the up, but now we're in a different market, like we said before. And I guess my first question is: one, what are the rates?
Yeah.
And two, what's the difference between a fixed rate and a variable rate? We're hearing all these buzzwords out there, and we just want to kind of break it all down.
Yeah, it's a great question. So, the way that I like to break down a fixed versus a variable rate. Well, let's start with a fixed rate. What you're doing is you're making a commitment to the institution and you're locking in an interest rate for a certain period of time. The advantage there is you're going to know, number one, how much your payment is. It's going to stay static. And number two, you're going to have full clarity on how much you're going to owe at the end of that term. So the way I usually explain it to my families and my clients, let's say you got a mortgage and you're going to pay the bank back over 25 years. For the first 5 years of that 25-year period, you say, I want a 5-year fixed rate. It's a buzzword. Everyone knows it. For the first 5 years, you're going to have a certain payment at a certain interest rate. At the end of those 5 years, we're going to send you a letter in the mail. Paul, you're awesome. You always pay us on time. We appreciate your business. We love you. How do you want to borrow the money for the next chunk of time? That's called the mortgage renewal. So what you're doing is you're biting off pieces of that 25-year time period, and that's really what a fixed rate is, in its simplest sense. Another big advantage is, again, having that clarity of knowing what you're going to owe at the end of the 5 years, right? On the flip side, variable rate, this is really what you're hearing in the news. When you're hearing in the news, Bank of Canada has increased interest rates. That's not having a direct impact if you got a fixed rate.
Right, for that term, yeah.
For that term, yeah. If you got a fixed rate, and I get calls all the time, and the good news for those clients, no impact. If you got a variable rate, what that means is effectively your interest rate has gone up. The big advantage of a variable rate is it's easier to get out of from a penalty perspective. So hypothetically, you got an investment property and a couple years in, you decide to sell it. Your penalty to get out of that mortgage is going to be a lot cheaper than if you're locked into a long-term fixed rate.
Okay.
Right? Going back to what you're seeing in the news, so yeah, rates are coming up, and probably a conversation I'm having at least on a daily basis, not multiple times, is what happens with my payment if I'm in a variable rate.
Right.
So different institutions do it different ways. The way that we do it is you've got a payment and it stays the same even as interest rates go up.
Right. Okay.
Right? Mortgage payment is broken down into two portions. Some of that money every month pays off your mortgage, the principal, and some of it goes to the bank in the form of interest. As interest rates go up, more goes to the bank and less goes to your mortgage. So you have the ability to increase your payment if you want to kind of stay on track and pay your mortgage off effectively, or you can leave it the same, but your mortgage balance isn't really going to go anywhere.
Now, with your clients in a variable,
Yeah.
what do you recommend?
Yeah, so I think every situation is different. The conversations I'm having is, number one, do you have the ability to increase your mortgage payment? Some clients and families don't, and that's okay. Secondly, if you have the ability to increase it, how much can you increase it by? And lastly, like, what's the goal? What's the goal of the property? I always like to go back to that. Why did you buy this place this home in the first place? Is it an investment property? And you say, Matt, I don't really care about paying this house off. Is it a house that you're living in? And you say, yeah, I want to stay on track because I want to retire at a certain age. If that's the case, you should increase your payment to keep yourself on track, right?
So I think the biggest concern that we have for our clients right now is what about those people that got their mortgage 4.5 years ago, and they're coming up for their renewal, their next chunk of the 25 or 30 or whatever they're in right now.
Yeah, you got it.
5 years is up, and their mortgage payment's going to look a lot different. Are we worried about these people? Are we going to? I mean, I've worked in the environment in 08, 09, 10,
right,
with a lot of foreclosures.
Yeah.
Are we going there again?
I don't think we're going to that extreme, at least hopefully not. But what we're doing is, we're proactively reaching out to our families and our clients to say, hey, what's the plan, right? If you got a mortgage renewing in the next 3 to 6 months, you hit the nail on the head. Your payment's going to be substantially higher than what it has been. So if you've gotten used to a lifestyle over the past few years and you can't afford an extra $500 to $1,000 a month on a mortgage payment, which a lot of families can't, it's a great opportunity to get in touch, and we can look at some different solutions. One of the key ones is restructuring your debt, right? You got car payments, you got credit cards, you got lines of credit. Let's restructure, roll that back into the mortgage and free up some cash flow. Secondly, I always like to just start with the question, like, what's the goal, right? Where do you see yourself 5, 10, 15, 20 years down the road? If you got kids and you want to put them through school, if you're looking to retire in 20 or 25 years, 10 years, whatever it might be, maybe you free up some cash flow and you start reallocating some of that money to your kids and to your retirement savings. You're not as concerned about paying off that mortgage. I think that's historically what we've always looked at, right?
So you could theoretically expand the payment term, right? If they have 20 years left, you can make it 23, 24, 25, ease the cash flow, and spread those payments out a little bit further.
Yeah, absolutely.
So that is an option. Okay, that's good to know.
Yeah, it's an option, and again, you can even go as far as 30 as long as there's the equity there in the house, right? At least 20% equity, and I think that is a really key option. And to go back to it, it's growing up, we've always looked at, let's pay the mortgage off, let's pay off our debt as soon as possible, but there's almost been, I'm finding, at least a little bit of a shift where, we still want to be aggressive and pay the mortgage off, but at the same time, we want to also have money to allocate to different places. Houses aren't as cheap as they were, 20, 30 years ago when you're making a pretty good wage and can pay your house off in 5 or 6 years.
I've got another good question for you. So let's say that 5-year terms comes up,
right?
And is the bank reassessing the property at today's value?
Yeah, great question. No, not if you do a straight renewal, right?
Okay,
So you get
okay.
the document and you sign off on renewing your mortgage. No, if you're looking to refinance, which you were touching on, Paul, and that's where you want to borrow some additional funds, that's going to trigger the need for an updated appraisal, and that's our opportunity to say, hey, how much is that property worth now? If it's 5 years ago, you're still going to be in the good, right?
Yeah.
The property is going to be significantly higher than it was 5 years ago. I would say it's more concerning for families that bought, maybe a year ago or 9 months
No,
ago.
I know in the height of the market, speaking of appraisals,
Yeah.
everything was appraising out. It's always our first checkpoint. If
Yeah.
we, in the back of my mind, and I would assume all the realtors here, is if I feel like this property may not appraise,
Right.
then I probably shouldn't be writing the offer.
Right.
Now, every offer that we wrote, I don't think anybody in here had a property not appraise. Are we seeing properties not appraised now, or?
Yeah, I haven't had any issues, which has been great. Haven't had any issues over the years that I've been doing this, to be honest. But going back to your point, it's if you're making an offer on the property, you got to have comparable sales data to support it, right? If an appraisal comes in, again, haven't had issues, but if an appraisal did come in low, we can always go back to that company and say, hey, here's the comparable sales data. Here was the rationale behind why Paul or Scott recommended to go in at this purchase price. Here's the sales recently, similar style home, whatever it might be, and we can look to kind of challenge it, right?
Gotcha. And then one more quick question. You mentioned, okay, so you got 20 years left on your mortgage.
Right.
The rates are up. Now you're up for renewal. Maybe you can expand those payments back to 23, 24 years.
Yeah.
Is there any talk of expanding that to 35, 40 years, 45 years? I've heard of other countries doing it because their real estate's really expensive. I've heard rumblings that it could happen here as a government's last resort, right? So people aren't losing their houses.
Right.
Have you heard any rumblings along those lines?
No, I haven't. I haven't heard anything, at least concrete. I've seen some of the same data that you're talking about with other countries, but haven't heard anything for Canada. Nothing concrete, at least. Just more or less an idea.
Gotcha. Good to know. Good to know.
What are the rates right now? Hit me with a 5-year fix.
Yeah.
And hit me with a variable, and what that means.
Yeah. So from a 5-year fixed perspective, you're looking anywhere around 5%, right?
Yep.
I was chatting with Scott before coming on. The really interesting part is right now, a variable rate, it's basically the same. And historically speaking, there's going to be a spread between a fixed rate and a variable rate.
The variable always wins in the long run. Am I right?
Yeah. Over the course of time, yes. Yeah. And the reason there's a spread, and when I say spread, the variable rate's got to be a little bit lower in theory than a fixed rate, is because you're inherently taking on that risk. When you're taking a variable rate, you're taking the risk of interest rates going up, which they have. So to compensate you for that risk, we're going to give you a bit of a lower interest rate. Really unique thing right now, again, is they're almost even. They're almost at the same level. So it's almost like the curve's almost inverted if you were looking at it on a chart. So that's kind of where you're looking at a 5-year fixed rate. I've had a lot of families and clients looking at a shorter term fixed rate, maybe a 2 or a 3-year term. And the reason there is the economists are predicting in the next couple of years, you're actually going to see interest rates come back down. Okay. So if you're coming up for renewal or you're looking to take on a mortgage, I've had a lot of clients say, well, Matt, I don't want to lock in for 5 years because then I'm locked into this higher, potentially higher interest rate for 5 years. I want to lock in for 2 or 3. So after 2 or 3 years, you can reassess and kind of see where you're at. If rates are lower, you're going to catch the downside, right?
A 2 or 3 year fix, obviously.
Correct.
Is that a higher rate?
Yeah, so the 2 or 3 year fix is actually at a lower rate than a 5-year fix because the less amount of time that you want to lock in your interest rate, the lower your rate's going to be because you're only buying the security for a shorter period of time. So probably about 10 or 15 basis points.
Gotcha.
Right? Not a huge difference, but the ability to select a new term after a couple of years, that's where a lot of families and clients think.
And I like that idea because I do agree. I'd have a hard time locking in for 5 years right now because I just have a hard time thinking they can keep going in this direction. But I've been wrong before. So, okay. And you mentioned that inversion earlier where the fixed and variable are so close. That's uncommon. What does that tell you, reading between the lines? What does that tell you?
Yeah, reading between the lines, it tells us that, moving forward, I think initially at least, we're going to see variable rates probably go up again, right? It's not what everybody wants to hear, but it's the truth, right? October, Bank of Canada's got another interest rate announcement, probably looking at another interest rate hike of 25 to 50 basis points, and maybe one more towards the end of the year. Once that's settled, I think we're going to kind of stay pretty even keeled for at least 12 months. And then we're predicting in 2024 is when we actually start seeing interest rates come back down. When the interest rates go up, it's not like an instant reaction. It takes time for the market to actually digest this stuff, right?
Yeah, for sure.
So it's going to take 2023, and at least, again, that's what the economists are predicting. And then 2024, we start seeing rates come down a little bit and everything kind of stabilizing.
Now, the interest rate's at 5%. Are we still having to qualify for a higher rate than that?
Yeah.
Is there still that, what's it called?
The mortgage qualifying rate, yeah, the stress test, yeah.
Stress test, that's right.
You got it, yeah, great
What's
question.
that at if it's at 5%? Is it
So it'll be,
always-
2% higher.
Okay,
So it's
so
always
seven.
2% higher than the interest rate that you're paying. And to touch on the stress test for anyone who doesn't understand it, fully, government introduced this as a measure where they said, okay, Paul, you got a mortgage at 3%, your payment's $1,000 a month. But what happens if interest rates go up in the future? Well, we're at the future point now.
Right.
Interest rates have gone up. And they were speaking to that point of, if you get that letter in the mail and your rates, up and your payments up, can you still afford it? So the idea is when you apply for a mortgage, we want to make sure that you can't only afford the payment now, but you can afford it as if the interest rates were 2% higher.
Which I think was a great idea.
Yeah, it's a built-in protection.
A buffer, yeah.
It's a buffer, exactly. So with interest rates going up, the qualifying rate also goes up, and it reduces how much you're able to borrow for the home. Interesting piece of data I saw recently was housing affordability has actually improved over the past month or so. There's 2 points of data that we look at, right? There's house prices and there's interest rates. House prices have actually come down faster than interest rates have went up since June. So affordability has actually
Right,
improved,
okay, yeah.
right? And I'm sure you guys saw that chart going around social media.
Well,
where,
and it's less of a down payment. It's
Yeah.
less land transfer tax. It's, of course,
Exactly.
the interest rate. So, I mean,
It may also be that when you add that extra 2% on, that means you can afford 2% less. That means the prices are going to come down 2% more. Like, does that make sense? So they're actually going to come down faster than the rates rise because of that extra 2% qualifying rate. They can get less money.
Exactly, yeah.
And what's 2% per $100,000? What does that cost? Or, any rough idea there?
Are you talking like on a mortgage payment?
Yeah.
I would say, I'll be honest, I'm kind of guessing, but probably $600 to $800.
Wow,
Yeah,
that's
so it's
huge for affordability.
Yeah, it's pretty substantial,
Yeah.
maybe even closer to 500. So yeah, it's substantial, right? 2% a 2% a
Yeah,
big number.
it's a big number when-
And looking at the start of the year, I think everybody knew, okay, interest rates are low, prices are going through the roof, but this isn't going to last forever.
right. It was unsustainable, by the way.
Correct.
And we even as realtors, like we look at it all. We're like, this can't keep going this way. Like,
Didn't make
this-
sense, right?
Especially in Windsor, we know how much the people make, and it's just you can't sustain these prices.
Right.
It's just too much.
Yeah.
So we wanted a correction. Did I think it would be this drastic? No way.
Exactly.
No way to drop over $200,000 in April, May, June, July in less than half a year. That's
I
wild.
didn't think they'd raise this quickly,
That's
this
it.
fast and furious,
That's it.
because it's such a shock and it's dangerous in my opinion.
Yeah.
But here we are, and like you were saying, it takes time to filter through the economy. All the stuff that they're looking at for inflation data, it's all lagging. So they're looking
Right.
3 months back and saying,
Exactly.
well, the rates haven't hit yet. Well, your data is 3 months old.
Right.
You should be looking forward. It might not be taking into account how much real estate prices have come down and fuel's down and this and that, whatever. So that we're probably going to be in this period for another 12 months before that data catches up to reality.
Exactly.
Yeah, so Mr. and Mrs. Smith walk in.
Yeah.
They've got an accepted offer.
Right.
Beautiful, conditional on financing. I'm sure you've missed that, and you're not against the gun all the time, right? So we
Yeah.
have 5 business days to figure out our financing. The price of the house, let's call it $682,000. It was listed at $699,000. We negotiated a little bit, got it down to $682,000. We were the only offer. It was
Yeah.
fantastic, right?
There you go.
What are we doing with them? Are we putting them in a fixed, or are we putting them in a variable? What's the recommendation?
Yeah, so I would say, Mr. and Mrs. Smith, going back to that original conversation, what are your goals moving forward? What's your risk tolerance, right? Some clients and families say, I don't have any risk tolerance. If that's the case, you're probably better off going in a fixed rate, right? If you're going to lose sleep at night over the interest rate on your mortgage, you probably want to go into a fixed rate. It's not worth it, right? But again, so you go back to the goals and you kind of understand and we would have had this conversation ahead of time, but how much are you comfortable from a monthly payment perspective? And I would give them, my opinion on where the market's going with some supporting data and kind of lay out the different options, right? What I'm seeing a ton of is, yeah, Matt, we want to either do a 2 or a 3 year fixed rate, or we want to do the variable rate. A lot of families are kind of shying away from a longer term fixed rate. They want that chance to reassess in a couple years, and just making it abundantly clear. In a couple years, you've got to pick a new term on your mortgage, right? Again, if you don't like that idea and you want to lock in long term, then you do that, right? Every family's different.
No, where were interest rates at its lowest this year? 199?
Yeah. Oh, yeah. Well, at its absolute lowest, we were at like 1.5%.
Wow.
Right. Like, COVID hit and things really came tumbling down. We were under 1.5% on like some pretty long fixed rate terms.
Yeah.
January, we're in the high 2s. And then we really started seeing things kind of take off. And now we're up in the 5s.
So mortgage payment at 2%.
Yeah.
Let's use a round number, 500,000.
Yeah.
What does a mortgage payment on 500,000 at 2% look like?
2% on 500 grand, I'd say probably $1,600.
And what's that look like at 5%?
Almost double.
Yeah.
Yeah, $3,000.
Guys, it's concerning.
Yeah.
Right? It's concerning. So no better time to get proper guidance and really lean on your professionals, whether it's mortgage broker, realtor, accountant, lawyer, all that stuff, and make sure you're getting the proper advice. And that's what this is all about. I mean, I wish I could have you on here every week, to be honest, because it's very important stuff. I think we were talking about before, I think some people are kind of scared or almost embarrassed not to know what their mortgage payment is or where it went,
right?
Or just aren't looking at their statements. I think it's and then you being in the profession, I think you welcome every phone call
absolutely
from your clients that come to you. If you're I assume you're probably doing them already anyways, but don't be scared to call your mortgage broker and say, hey, listen, where am I at here? What's it look like for me? And should I be doing anything different? Because they'd be more than happy to help.
Yeah, we recommend, at least on our team, is we reach out to our clients to do an annual mortgage review, right? I think everybody, when you look at it from an investment perspective, you got investments, and you do an annual review. How have my investments done over the past 12, over the past year, over the past 12 months? Why not do the same thing with your mortgage? It's, in a lot of cases, it's a large sum of money. You've invested in a property. Let's do an annual mortgage review, and not just simply, this is how much you owe, your payment's staying the same, whatever it might be. Let's have that conversation. What's changed in the last year? Oh my God, you're pregnant, you're expecting, congratulations. How's that gonna impact things? Oh, you're gonna be on mat leave, so your income's gonna be impacted. You've been pretty aggressive with your mortgage. Have you thought about maybe turning that down? Maybe you wanna refinance and pull out 20 grand to dump into a bank account while you're on mat leave to kind of hold you over, right? So I think that's key. An annual mortgage review. I think that needs to start happening on a more regular basis.
Biggest asset. It's your biggest investment.
Yeah.
I mean, it's. I'm going to end with one last question, and hopefully Scott will have one last question as well. I want to talk about trigger rates. Like, what do we break down? Again, buzzwords out there.
Yeah.
Trigger rates only apply to variable mortgages. Am I right?
Correct.
So why don't you dumb that down for us and really explain what a trigger rate is?
Yeah. So. Absolutely hearing about it in the news on a regular basis, right? So I think the key to kind of understand here is there's a trigger rate and there's a trigger amount. And I'll kind of explain the differences. So on a variable rate mortgage, going back to what we talked about earlier, let's say you got a payment of $1,000. The way that payment's split up is you got maybe $500 going towards your mortgage principal. So your mortgage is coming down by $500 a month, and you got $500 going towards interest. As interest rates go up, if you're in a mortgage where your payment doesn't have to increase and you're not required to increase it, more of that money is going towards the interest and less is going towards the principal. So use that same example, $1,000. Instead of a 500-500 split, maybe you're at $250 is going towards your mortgage and $750 is going towards interest. The trigger rate is when your interest rate has gotten so high, all of your money is going to interest. So your mortgage isn't coming down anymore. It's actually staying the same.
Would that drag your term out then, your amortization?
No, good question. So what happens is all of your money is going towards the interest and your mortgage balance is staying the same. And in some cases, it's actually growing because if the interest rates are high enough, your payment might not even support the interest. Your mortgage starts growing again, okay? Now, the trigger amount, not the trigger rate, but the trigger amount is the point where your mortgage grows so high, we're going to call you from the bank and say, hey, like, Paul, Scott, you got to increase your payment here.
Yeah.
Like, your mortgage is basically getting out of control, and it's grown to, in some cases, higher than what it began with, right? The amortization, it stretches out during your term, but going back to this whole renewal thing, at the end of your 5 years or your end of your 3 years or whatever it is, we're going to simply look and say, how much money do you have left on your mortgage? And we're going to get you back on track. We're going to stretch it back out over 25 years or 27 years, whatever you're supposed to have left. Yep. So we were talking about it before the show. Like, at a certain point, you kind of gotta pay up in the sense of, if you don't increase your payments during your term, you're going to have more money left when it's done, and your payments are going to be higher on your next term of your mortgage when you renew. Right. So I hope that makes sense.
Yeah, at some point, you're going to have to pay the piper, right? Like,
exactly.
Whether it's now or in the future.
That's right. So if you can increase the payments now, great. You're going to have a little bit less owing in a few years. If you can't, you're still going to have that amount of money owing, and we're going to stretch it out over the same period of time. We're going to get you back on track.
I always like to find the positive in things. And, give me some positive out there in your world.
Yeah, so I think
I guess, sorry to interrupt, man. I guess where's the opportunity lie, in your opinion, in this market? Every market presents great opportunity.
Yes.
What's the positive in the mortgage world right now?
So I think the positive in the mortgage world, number one, from an investment perspective, right? If you got capital or you have access to capital and you're looking at investment properties, like, the price to rent ratio has been moving in the right direction. And I think there's potentially some opportunities out there. And the positive spin I'll put on it is this. Moving into the fall and the winter, historically, there's less listings that come onto the market, right? In Windsor, Essex, our sweet spot, and it's different for every community, but our sweet spot's 3 months of inventory. That's when we're in a stable market. Right now, we're at 4 months of inventory, which means it's a buyer's market. Less listings coming on in the fall and the winter. Some of those buyers are going to scoop up those homes. My hope is by the spring, we're down to closer to 3 months of inventory. We're in a stable market. What does that mean? Prices are stable. There's an equal number of buyers and an equal number of sellers. And we can kind of come together and do business kind of the way we used to 5-6 years ago, where you can go and view a house more than once, and you don't got to make a decision within an hour, and conditions, all those kind of things, right?
Yeah, actually a very, very enjoyable market to work in, for sure. My biggest indicator is Q1. I have to see how that behaves. Our market starts to rise every year. I always say that first full Monday back after New Year's Day is really when our spring market starts. It has for the past 6 years. I don't see. Well, I could see why this year would be different because of the interest rates. But I'm excited. I know the rest of the year it'll be at this pace. But I'm excited for Q1 to see where we're at. But interesting times out there, and
very interesting. I'm with you, man. I think Q1. I think we're going to start seeing some good data, and things are going to be trending in the right direction.
Absolutely love it.
Yeah.
I guess my final question here would be, I know the Canadian banks, the oligopoly, the big five banks, I view them as fundamentally intertwined with the Bank of Canada and the economy. And are you engaged in meetings with the economists for the Bank of Canada at all? Are you getting that top level data that kind of filters through you and then down to the population? Is there anything on that end that you guys are seeing, or is that just not something that really happens?
Yeah, like not me personally, obviously, but we do have some lead economists, and they're the ones who really are absolutely having those conversations with the Bank of Canada, and they're giving us the indication again that moving forward, we're going to see a stabilization. That's the hope in 2023, and then rates potentially actually coming back down in 2024. And that's straight from them, based on data that they have access to, the best information that they have access to. I think you said in the intro, no one's been able to predict interest rates ever. So we use data that we have available, and it's kind of like on a best guess scenario. But that's the other positive outlook, right? Rates are going to come down eventually. It's just a matter of when, right?
And one thing, when we were talking before the show, you mentioned that the fact that the variable and the fixed are so close together is an indication that in the next 12, 18 months, whatever it might be, the bank's not stupid and they don't lose.
You got it.
So it's indicating that that variable rate is likely to come down.
Absolutely.
Yeah, so because I'm hearing crazy rumblings, right? Some people are saying 12% interest rate, 17%, and all these crazy things. So there's a lot of fear out there,
Right.
And I'm trying to look past the fear and look at the data. What are the banks doing? What are they saying? What is the Bank of Canada saying? Is inflation coming down? Right, I'm looking past the noise.
Absolutely.
So that's really good information there.
Yeah.
Yeah.
Absolutely. Yeah, I appreciate you guys having me on.
Yeah,
How can
great
people get a hold of you,
conversation.
Matt?
Yeah, obviously phone call, text, or email. Maybe we can throw up a little blurb
Absolutely.
at the end with all my info. And yeah, we're available. We've got a great team. And at the end of the day, we just want to help as many families out as possible, give good, solid advice, and look past the transaction itself. Look at what are your goals? How can we help you achieve them? And let's not only look at now, let's look at the future as well.
Yeah, speaking my language. Nice to have you on the show.
Yeah, thanks so
Appreciate
much,
you.
guys. Appreciate
Okay,
it.
yeah, absolutely.
Thanks, man.
Thanks, Matt.
Appreciate it.